Revenue recognition, part 2. What we're going to look at now are warranty options, which are warranties that go beyond what normally a product would come with. And variable consideration, which is looking at the effects of something that may affect the revenue stream. Now, what we're really looking at here is what we call extended warranties. And they are affected by Rule 2 and 5 of the revenue recognition rules. Because first, identify the performance obligations. A single extended warranties. A warranty is an extended warranty if either the customer has the option to purchase the warranty separately or the warranty provides a service to the customer beyond quality assurance. If a warranty is not sold separately, then it simply is a cost to assure that the product is of good quality. The seller will estimate and recognize an expense, warranty expense, and related contingent warranty liability in the period of the sale. So that's something separate. We're talking here about revenue. Step 5, recognize revenue when or as each performance obligation is satisfied. So now we're going to look at an example. In this example, Mike's Computing sells a computer called the Danny. The $780 sales price of the Danny package includes the following: one Danny computer, a 6-month limited warranty. This warranty guarantees that Mike will cover any costs that arise due to repair or replacement associated with defective products for up to 6 months. A coupon to purchase a Danny ebook reader for $200, a price representing a 50% discount for the regular price of $400. It is expected that 20% of the discount coupons will be utilized. And a coupon to purchase a 1-year extended warranty for $50. Customers can buy the extended warranty for $75 at other times if they do not use the $50 coupon. Mike estimates that 40% of the customers will purchase an extended warranty. Mike does not sell the Danny without the limited warranty, option to purchase an ebook reader, and the option to purchase an extended warranty, but estimates that if it did so, a Danny by itself would sell for $760. The company sold 1,000 Danny packages for cash. Now, example 1, we're going to look at what are our performance obligations. Okay, the computer, yes, we're going to provide a computer. The limited warranty, no. Because, again, if a warranty is not sold separately, then it's simply the cost to assure that the product is of good quality. Option to buy an ebook, option to extended warranty. These are both additional obligations because they provide a material right to the customer that the customer would not receive otherwise. The option is capable of being distinct because it could be sold or provided separately, and it is separately identifiable as it is not highly interacted with other performance obligations. So we have 3 performance obligations to assign the $780 to for a sale, each sale of the package deal. Now, first we're going to allocate the $780 based on standalone pricing. So we know that if we add up the fair market value, it's going to be $810. However, we can only allocate $780. So what we have to do is take the fair market value of each of our 3 performance obligations, divide them by the total fair market value, get a percentage, and then take that times the $780 to determine how much of each computer will be allocated to each one of the components. Then we're going to do a journal assuming we sold 1,000 units for cash. So cash would be $780,000. Sales would be $731,870, and deferred revenue, discount option, deferred revenue, extended warranty. Both of these would be set up as deferred revenue. Now, our next example is going to be variable consideration when we have a right of return. Now, step 3, estimating the transaction price involves a variety of considerations, including estimating variable consideration and determining whether it is constrained, sales with a right of return, a particular type of variable consideration, identifying whether the seller is acting as a principal or as an agent, time value of money, and payments by the seller to the customer. Right of return exists when the customer can return the good if not satisfied or unable to resell it. Viewed as a failure to satisfy the original performance obligation, the seller reduces revenue by the estimated returns and either records a liability for the cash the seller anticipates refunding to customers when an offsetting entry to a contra revenue account, sales returns, or reduces accounts receivable if the seller has not yet been paid and makes an offsetting entry to a contra asset account called allowance for sales returns. So now let's look at our example. Okay, in this case, we're estimating, based on our history, that we have returns of 20%. So we're going to walk through our 5-step process. First, identify the contract. Was signed to provide merchandise. Performance obligations. We have only one, but we have to adjust for our variable consideration. A right of return is not a performance obligation. Remember that when you're doing your homework. Now, determine the transaction price. It's $8,000 less than estimate for the right of return. Allocate the transaction price to the performance obligations based on fair market value. The performance obligation will be allocated between the delivery of the merchandise and the end of the return period. So, the company will recognize revenue $8,000 less the estimate for the right of return when the goods are delivered and when the performance obligation is met. So, let's take a look at this. If they paid cash, we would go cash, sales returns and allowance, which is $8,000 times 20%, and sales revenue. We would only recognize 80% of it. If not, we reduce accounts receivable. By setting up our allowance for sales returns and allowances. So again, we're still only going to book revenue of $6,400. Now, what if instead we can't estimate the number of returns? Then no revenue would be recognized because Hunt the seller can't estimate returns. It treats this transaction if it's placing those goods on consignment with an independent distributor. Now, another example. What if there are additional services? So in this example, Mike sells boots, and as part of the offer, people can buy a $70 pair of boots, but they also get a 30% off any additional shoes they buy for the next 30 days. The coupon is only available with the night boot, and it estimated that 20% will be redeemed for additional merchandise with a sales value of $100. How many performance obligations, and how do you allocate the sales price? So now we're going to go through our process again. We have two things we're going to do. The customer is entitled to a pair of boots and a coupon. We have two performance obligations, the pair of shoes and the coupon that provides a material right to get 30% off their next purchase. We must determine standalone pricing for each of the performance obligations. So the performance obligations we met based on receiving the shoes and redeeming the coupons within 30 days. The company will recognize revenue at each purchase based on using the residual approach. Now that is what you would do, and I will show you what that means, is if you only have some of the items, what you do is you take what you know and you subtract it from the total transaction price. So we can estimate the value of the coupon, which is $6. So for each unit, $64 goes to the boot and $6 to the coupon. If 1,000 night boots were sold, the journal would be cash, sales revenue, and deferred revenue. And that ends part 2.